January 30th, 2026, a date that will go down as one of the most violent trading days in modern commodity history. In less than 24 hours, silver collapsed 37%, from a high near $121 an ounce to a low just above $75. No war declaration, no demand collapse, no mine discoveries, no industrial slowdown, just annihilation. And that's exactly why this was not a market correction. It was an execution. Because markets don't behave like this naturally. Corrections happen when sentiment shifts. Crashes happen when fundamentals break. This was neither. This was forced, calculated, and executed with surgical precision. To understand what really happened, you have to stop looking at price and start looking at mechanics, because silver didn't fall. Silver was pushed. Let's talk about the weapon used, margin. Over the 6 weeks leading into the crash, the CME Group, the exchange that controls silver futures, raised margin requirements 4 separate times. Not once, not twice, 4 times. An 80% total increase in margin requirements. That means anyone holding a leveraged silver position was suddenly required to post tens of thousands, sometimes hundreds of thousands, of dollars in fresh cash. Immediately, no grace period, no warning. And here's the part retail investors don't fully understand. When margin goes up, you don't get to negotiate. You either wire the cash, or your position is liquidated automatically, at market price, into a falling market. That's how waterfalls start. That's how bids disappear. That's how prices gap down violently with no buyers. This wasn't selling driven by fear. It was selling driven by force. Think of it like this. You're not watching people choose to exit a burning building. You're watching the exits being locked, while the floor collapses underneath them. And once the first wave of forced selling hits, it feeds on itself. Prices drop, margins rise in real terms. More liquidations trigger, stops get hit, algorithms flip short. Liquidity evaporates. This is not chaos. This is a designed outcome. And here's where the story gets uncomfortable, because this exact playbook has been used before, multiple times, always on silver, always at critical moments. Let's rewind. Silver had risen over 800%, public participation exploded, confidence in fiat currency was cracking. So what happened? The exchange banned overnight leverage buying. The Federal Reserve spiked interest rates. Margin requirements were changed mid-game. Silver collapsed 80%. Fast forward to 2011, silver rises nearly 600%. Debt crises everywhere. QE in full force. Trust in central banks eroding. The response? The CME raised margins 5 times in 9 days. Silver crashed 50%. Now 2026, silver rises 450%, breaks triple digits, exposes inflation lies, threatens the dollar narrative, and suddenly, margins are raised 4 times in 6 weeks. Silver crashes 37% in 1 day. Different decades. Same response. Same result. That's not coincidence, that's policy. And it raises the most important question of all. Why? Why does silver trigger this response every time? Why not oil? Why not copper? Why not tech stocks? Because silver is not just a commodity. It's a monetary signal. When silver explodes higher, it screams something central banks don't want heard. That paper money is being debased. That purchasing power is evaporating. That confidence in fiat is cracking. Gold whispers that message. Silver broadcasts it. Silver is small enough to move violently, widely held enough to attract the public, and historically tied to money enough to scare policymakers. That's why silver doesn't get allowed to discover price, not freely, not honestly, not when it threatens the system. And make no mistake, this crash happened as silver was doing exactly that. The physical market was screaming shortage. Mints were running out. Dealers were defaulting. Lease rates were exploding. Vaults were draining. So what did the paper market do? It pulled the emergency brake, hard. And just like every time before, the crash was blamed on volatility, on speculation, on overheating. But volatility doesn't come from thin air. It comes from pressure. And pressure was applied deliberately. This wasn't about protecting investors. It was about protecting the dollar. Because while silver was collapsing on screens, something else was happening quietly. The physical metal wasn't being sold. It was being bought. And that's where this story really turns dark. Because while the West was dumping paper, the East was accumulating reality. China wasn't selling. China was draining vaults tons at a time, day after day. And that's not speculation. That's logistics. Silver didn't disappear. It changed hands. And when you see forced selling in the paper market, alongside hoarding in the physical market, you're not watching a correction. You're watching a transfer from weak hands to strong ones, from leveraged traders to sovereign buyers, from paper promises to metal that can't be margin called. And this is exactly where I'll almost pick up in part 2. Because once you understand who benefited, you'll understand why this had to happen. And why, despite the violence, This may be the most bullish signal silver has ever given. Now here's the part that never makes the headlines. While silver was being obliterated on paper in New York, it was being vacuumed up elsewhere. Not sold, not dumped. Accumulated. Because this crash didn't destroy silver, it redistributed it. Let's talk about the divide that defines this entire event. West versus East. Paper versus physical. In the United States and Europe, silver trades as a contract, a promise, a digital entry that can be margin called, halted, repriced, or cash settled. In Asia, especially China, silver is treated as strategic material, something you stockpile, something you control, something you don't give back once you have it. And during this so-called crash, China was not panicking. China was buying. Reports out of Shanghai showed 27 tons of silver drained from vaults in a single day. Let that sink in. That's not speculation. That's logistics. That's trucks moving metal. That's inventory disappearing. And remember, Shanghai vaults already held barely 1% of annual global demand. There is no cushion, no buffer, no hidden pile waiting to save the system. At the same time, China has officially classified silver as a strategic resource. Export restrictions, licensing controls, priority allocation. And here's the critical piece most people miss. China controls 60 to 70% of global silver refining. Which means they don't just mine it, they decide who gets usable metal. So while the West smashed the paper price, the East quietly tightened supply. That's not accidental, that's asymmetric warfare. And it exposes the greatest illusion in all of modern markets, that paper price equals reality. Because if silver was truly collapsing, you'd see it everywhere. Coins piling up, bars discounted, dealers begging for buyers. Instead, what do we see? Mints shutting down, delivery delays, no inventory banners, default notices in India, purchase limits at major retailers. That's not a bear market, that's a shortage. And shortages don't resolve themselves with lower prices. They resolve themselves with higher ones, violently. Now let's talk about the motive. Because this wasn't just about silver. Silver was the front line. This was about defending the credibility of fiat money, of treasury markets, of a financial system built on leverage and confidence. When silver explodes higher, it does something dangerous. It exposes real inflation. Not CPI math, not adjusted baskets, but lived reality. Silver touches energy, food, technology, defense, infrastructure, AI, solar, medical systems. When silver prices rise uncontrollably, it tells the world something central banks cannot allow to spread. That money printing has consequences, that debt matters, that promises fail. And here's the uncomfortable truth. The intensity of the attack is the signal. You don't raise margins 4 times. You don't trigger forced liquidations. You don't risk credibility. You don't smash a market this hard. Unless what you're fighting matters. Silver was becoming uncontrollable, and control had to be reasserted. But here's where the story flips. Because this tactic has a shelf life. You can crush paper price. You can scare speculators. You can force liquidations. But you cannot print metal. You cannot margin call a coin in a vault. You cannot rehypothecate what's already been consumed by industry. And silver is being consumed, lost, irrecoverable. Electronics, solar panels, AI data centers, EVs, military systems, medical devices. Once silver is used, it's gone, forever. Gold gets recycled, silver gets destroyed, which means every shortage compounds, every deficit stacks, every manipulation digs the hole deeper. And that's why this crash wasn't a victory, it was a desperation move, because the fundamentals didn't break, they tightened. The 5-year supply deficit didn't vanish. Industrial demand didn't slow, mines didn't suddenly flood the market, central banks didn't reverse course. All that changed was the screen price, and screen prices lie. This is why the distinction matters. Paper silver is a trade. Physical silver is a position. Paper silver can be halted, repriced, cash settled, liquidated. Physical silver cannot. It doesn't care about margin. It doesn't care about CME rules. It doesn't care about trading hours. It just exists. And that's why this moment matters. Because we are watching the gap widen between what silver is priced at and what silver is worth. That gap never closes quietly. It closes with force. History tells us that when paper and physical diverge long enough, they don't reconcile gently. They converge violently. 1979 didn't end slowly. It ended in a vertical move, and here's the final point you need to understand. This crash was meant to teach a lesson, to scare, to humiliate, to remind markets who's in charge. But it also revealed something else. That control is slipping. Because the more aggressively silver is suppressed, the louder the signal becomes, and the entities that understand this are not selling, they're accumulating, quietly, relentlessly, without leverage. So the real question isn't, why did silver crash? The real question is, why did they need it to? Because when the response is this extreme, It tells you the threat is real. And silver is still very much a threat. If you found this breakdown valuable, share it, because most people are still staring at the illusion and missing the transfer happening underneath. This is not financial advice. This is financial reality. Stay aware, stay skeptical, and understand the difference between price and truth.